Everyone is saying that now your loans will get cheaper as RBI has cut the repo rate to 5.25%. But how do you calculate the interest rate at which your portfolio company is getting loans? Let me guide you step by step to calculate this effective interest rate. The formula is interest for the year divided by average borrowing. You may ask why average borrowing and not borrowing for the year? Because balance sheet is snapshot of a moment and that moment is 31st March of the financial year. Suppose your company took a loan on 1st December 2024 and repaid on 1st February 2025. The borrowing will not reflect on the balance sheet because it is prepaid on 31st March, but the interest will be recorded in the P&L. Now the interest rate will be overstated because the interest has been recorded but there is no borrowings. So to mitigate this problem, we will take the average of current year and previous year. And let's take example of a listed company called Manorama Industries to calculate the interest rate step by step. You will take the finance cost from the income statement. Here it is 3916.43, and in the footnote, if it is mentioned that interest cost includes lease liability, then you will also have to calculate the lease liability in the debt portion because it is now treated as debt. And in the balance sheet there will be the short term borrowings, long term borrowings, and also lease liability. And in the short term borrowings, the first is short term loans. Here it is stated as working capital facility, and another is current maturity of long term borrowings. What is that? Suppose you had taken loan of 100 CR for 10 years. Now in this year you have to pay 10 CR. So this 10 CR becomes your current portion of your long term borrowings. Now let's calculate the effective interest rate. Interest cost we will take from the income statement, and the short term borrowings, lease liability, long term borrowings, and long term lease liability we will take for the financial year 2024 as well as financial year 2025. And for the formula, we will take the interest cost from the income statement divided by average borrowing. Effective interest rate comes out to be 9.45%. Now if this rate is extremely low, you will also have to check for the interest cost capitalization, but that's a topic for another video.